Okay. Good morning, students. As I promised you, um, I will do a videotape for the amortization of bond discount and bond premium. Okay. Please just understand at the beginning. I'm going to use, by the way, use the example in your textbook on amortizing bond discount and amortizing bond premium. And that is on pages 557, pages 557 um, through 566, 557 through pages 566. Okay, 557 through 566. Okay, those are the pages where the amortization of bond discount or premium is located. So I'm going to use the same example. Now remember, if the market interest rate is higher than the stated interest rate, then the bond is issued at a discount. If the market interest rate is lower than the stated interest rate, then the bond is issued at premium. Okay. Now, for amortization, there are two methods: straight line methods and the effective interest methods. And I do believe the effective interest method is more widely used than the straight line method. But we will do both of them for explanations here, okay? So we can understand the two methods. Now, let's start with the discount. If the current corporation issued the bond that has a $200,000 face value, 5-year bond, interest is payable semi-annually, and the market interest rate is 8%, and the stated interest rate is 7%. That's what the example says. So in this case, the journal entry, this bond, that means the market, the sales value, the sales value or the present value of the bond is 191,889. Okay, and the stated value is, so if you do the present value of the, if you use the present value to find the issue price of the bond, okay, you're going to end up with, like we explained in details in the previous recordings, you will find the issue price, or this bond is sold at 191,889, and so we have a discount of 8,111, and that's the difference between the face value of the bond and the issue price of the bond. Now, this is a 5-year bond. Okay, we're going to use the straight line first. Okay, we're going to use the straight line method. Straight line method, and since this is a 5-year bond and the interest is payable twice a year, so we will have a 10 interest payments. We will have a 10 interest payments. That means we have to divide the 8,111. We divide it by 10 periods, and that's going to give us $811. Okay, so every period, every 6 months, we will have to amortize $811. Okay, $811, 11.1, we'll just say $811. Okay, we know the obligated interest, what we are obligated to pay interest to the bondholders is the face value, which is 200,000, times the stated interest rate, 7%, times 6/12, because that's payable every 6 months. 6/12, and that's going to give us, okay, let's see. We're going to say 200,000 times 7% times 6/12 is going to give us $7,000. Okay, so every 6 months we have to amortize $7,000 of the every 6 months that is the obligated interest that we have to pay for the bondholders. Now, please do understand what amortization means here. Okay, it has to do with the amount of interest expense that we recognize in the income statement. Okay, when we have a discount, the interest expense is going to be a little bit higher than that we will recognize in our income statement, and expense higher than what we pay. Okay, we are paying $7,000 as interest, but we actually recognizing more interest expense on the income statement, and that's because of the discount. So the discount is going to cost us a little bit. Okay, when we collected money, when we collected $191,889, we're supposed to collect $200,000, but we collected $191,889. That's the price we have to pay in order to sell our bonds. Okay, so that's why we will have to pay a little bit more interest expense. Okay, so we do have a total of $8,011 unamortized bond discount. We divided by 10 periods, because it's a 5-year bond and the interest is payable every 6 months. So every 6 months we have to pay we have to recognize $811 of the interest expense. So the first interest payment is going to be, we're going to debit interest expense, and we're going to credit cash. The cash, we know that we are obligated to pay $7,000. Okay, and the interest expense. So originally, guys, the unamortized bond discount has a debit balance. So when we amortize it, we have to credit it. All right, so we're going to credit unamortized bond discount for $811. Okay, and therefore the interest expense is going to be $7,811. Okay, $7,811. Okay, let me start. This one is going, so you won't be confused within the circle. We debit interest expense. Automatically, guys, you're going to debit interest before you put the numbers. You debit interest expense and you credit cash. Cash is the obligated interest we have to pay for the bondholders. But we are actually recognizing more interest because of the discount. So the total interest expense is going to be 7811. See, the discount, the straight method is easy. It's not difficult. You have to do the same journal entry 10 times. Okay, every 6 months you see the do the same journal entry every 6 months, the same one, because it's straight line. You divide the 8,011, the total discount, by the number of interest payments. That will give you 811. Okay, and that means every 6 months you amortize $811. So these are an additional expense on the top of what we're supposed to pay. Okay, now what's happening to the every time you amortize a portion, the 8,011 goes down a little bit, okay? But the carrying value or the issue price or the book value of that bond will go up. The 191 is going to go up a little bit toward the face value. It's going to go up by 811. Every period that will go up by 811 until it gets to $200,000. Okay, that is the straight line. Okay, amortizing discount using the straight line. Now, if we use the effective interest method, the second method, effective interest method. Okay, the interest expense, the total interest expense that we recognize is going to be straightforward. You're going to multiply the carrying value or the issue price of the bond by the market interest rate. Okay, in our case, the market interest rate is 8%. Again, I'm using the same example in the book. The market interest rate is 8%. Our stated interest rate is 7%. So we're going to say 191. Okay, let me use a different color. Okay, we are using the effective interest method. We're going to say 191,889 times the market interest rate, 8%, times 6/12. Okay, times 6/12. And that is, I am using the calculators. There is nothing wrong with that. Okay, 191,889 times 8% times 6 divided by 12. 7,000 is equal to 7,000. 7,676. 7,000 is actually 7,675.56, but we'll just say 7675.56, so we'll just say 7,676. Okay, so this is the interest expense that we will recognize. So we're going to debit interest expense for 7,676. Okay, and we are going to credit cash for 7,000. Okay, for 7,000, and the difference we credit the difference between the two, and in this case, unamortized bond discount, unamortized bond discount for 676. Okay, 600 debit, interest expense 7676. Cash, that's the obligated payment that we make for the bondholders, and uncredit to make up the difference. Credit unamortized bond discount for 676. Okay, in this case, the debit equal the credit. So, because it's called the effective interest method, we use the effective interest rate or the market interest rate, and we apply it to the issue price. We don't apply it to the face value, okay? Be careful. We apply the market interest rate to the issue price. That's why it's called effective interest method. Now, the next journal entry, the next interest payment, we're going to update. Every time you do a journal entry, you update the issue price of the bond. Okay, we update the issue price of the bond. That means, since we are, remember, we said every time you amortize the cash value or the issue price of the bond is going up a little bit. Now it's going up by 676. Okay, so the new issue price of the bond, the new issue price of the bond, the new issue price of the bond is going to be 191,889 plus 676. Okay, so it is going to be 191,889 plus 676, and that will give us 192 equal 192,565. Okay, 192,565. Okay, so let me do some cleaning here so we can do the new journal entry. Okay, let me do the okay. So the new carrying value of the bond is 192,565 multiplied by the market interest rate times 8% times 6/12, and that will give us, okay, I'm using the calculator. It's okay, you can use your, even though I don't allow the phone in the classroom, the regular classroom, you have to have your own calculator, but yeah, we'll do an exception. You can do it, use the calculator now. Okay, 192,565 times 8% times half of that times 6/12. That gives us 7,703. It's actually 7,702.6. So we'll just do it to the nearest number. Okay, so this is the new notice is a little bit higher than the first one. Okay, the first one was The first one was, yes, 6. The first one was 7676. Now it is 7703 because the issue price of the bond or the carrying value of the bond went up a little bit. So we're going to debit interest expense for 7703. All right, and we're going to credit cash. That's the obligated value. I keep repeating, obligated interest that we have to pay to give to the shareholder, the bondholder, $7,000. And we're going to credit unamortized bond discount for 703. All right. Notice the first time it was 676. Now it's 703. Now, for the next journal entry, we have to update the new carrying value. Every time you do an adjusting entry, you do a payment of interest entry, you have to update the carrying value of the bond. So the carrying value, it went up to 192,565. Okay, it went up to 192,565. Now we're going to add to it 703. So the new carrying value, the new carrying value of the bond is 192,565 plus 703. Okay, plus 703, and that will give us 192,565 plus 703. 192,565 plus 703. That gives us 193,268. 193,268. And again, we multiply 193,268 times the market interest rate, 8%, times 6/12. Okay, times that will be 193,268 times 0.08 times 6/12. That will give us 7,731 equals 7,731. Notice it goes up. Every time it goes up a little bit because the carrying value of the bond goes up also. That's going to give us a higher interest rate. Okay? So, again, we do the same like what we did here and here. So let me do this new journal entry over here. Okay, we debit. This is the third interest payment. We debit interest expense, and we credit cash, automatically cash for $7,000. Interest expense is 7,703. let me see. How much the new one? The new interest expense is 7,731. 7,731 here. 7,731. Okay, and then we amortize. That's credit cash, credit unamortized bond discount for 676. No, that's going to be 731. 731. Okay. All right. You keep doing the same thing. You update the carrying value, multiply by the market interest rate, and that give us the new interest expense. Okay. Now let's do the amortizing the premium. Okay, let's amortize the premium. Let me change this whole. The premium, guys, means that the market interest rate is smaller than the stated interest rate. The market interest rate is smaller than the stated interest rate. Therefore, the issue price is going to be higher than the face value of the bond. Okay. All right. So if the market interest rate, we do the same example. If the market interest rate is 6% now, okay, the stated interest rate is 7%. In our example, the Carrot Corporation that issued the $200,000 face value of bond at 7%. Okay, so when we use the present value to figure out the issue price of the bond, like we explained in the previous recording, okay, the present value of the bond is going to be 208,530. 208,530. So we're going to debit cash for 208,530. And we're going to credit bonds payable for 200,000. And the difference between the two is the unamortized bond premium. Unamortized bond premium for 8,530. Okay, that is the original journal entry for issuing the bond at a premium. Now, again, both the discount and the premium are going to affect our interest expense. Okay, we're still obligated to pay the $7,000. Okay, but the interest expense is a little bit different based on whether we have a premium or discount. The discount will increase our interest expense, and the premium will decrease it a little bit, as we're going to see in a minute. Yeah. So we have a total premium of 8,530. All right, we're going to divide that. Okay, first is the straight line. Using the straight line. Okay, we will divide 8,530 by 10 payments, since it is a 5-year bond with interest payable twice a year. Okay, so 8,530 divided by 10. It doesn't need calculation anyway. 863. 863. So every time we pay interest, we have to amortize $863 dollars from the unamortized bond discount. So, as usual, we're going to debit interest expense, first interest payment, and we're going to credit cash. Okay, cash automatically $7,000. Okay. Now remember, the unamortized bond discount has a credit balance. Okay, and when we amortize it, we have to debit it. So we're going to debit unamortized bond discount. We already know for 863. All right, so the difference between the two is going to be our interest expense. Okay, and so we're going to say 7,000. Okay, minus 863 will give us 6,137. 6,137. Okay, so since this is the straight line method of amortization of the bond premium, you're going to do the same journal entry every 6 months, because we divide the 853, the total premium, by the 10 periods. So you do the same thing until you amortize all the 8,530. So every time you amortize the portion, the carrying value goes down. This time, the carrying value goes down, okay, toward the 200,000. Okay, when the carrying value becomes 200,000, that's it. You amortize the whole discount and premium, and you paid off all the interest due. All what's left for you to pay is the face value of the bond. So you will, when we have a premium, the carrying value of the bond is going down until to get to 200,000. When we have a discount, the carrying value goes up toward the $200,000. Okay. Now let's do the effective interest, amortizing using the effective interest method. Okay, so again, you do the same journal entry when we have the straight line method. Okay, effective interest method. The reason why it's called effective interest, because we use, like we said with that discount, we use the effective interest rate or the market interest rate to figure out the interest expense. Okay, so in this case, the carrying value or the issue price of the bond is 208,530 times the market interest rate, which is 6%, times 6% times 6 over 12, and that will be, we're trying to figure out the interest expense for the first interest payment. Okay, 208,530 times 0.06 times 6 divided by 12. It will give us 6,256. 6,256. 6,200. Okay, it's actually 6,255.9. So just to make it to the nearest number, so we'll say 6,256. Okay. Now, we are going to debit interest expense, and we're going to credit cash. Cash, automatically $7,000. That is the obligated value that we have to pay. Okay, and the interest expense now we know it is $6,256. And now how much do we amortize of the premium? Is the difference between the interest expense and the cash value. The obligated, see, we pay $7,000 interest expense, interest to the bondholders, but we recognize $6,256. Okay, so how much do we amortize? We amortize 7,000 minus 6,256 will give us 700, and unamortized bond discount is 744. Okay, that is the first interest payment. Notice, guys, that the interest expense is a little bit smaller than the what we pay, and that is because of the premium. So the premium will have the tendency to lower what we recognize in interest expense, and the discount, as we saw earlier, has the tendency to raise the interest expense that we have to recognize. Okay, so the next journal entry, we're going to adjust the 508, 530. Okay, and we again multiply it by the market interest rate as we did earlier. So the new carrying value of the bond or issue price, the new, let me use a different color here. Okay, where's my red? Oh well, I'll just use these. Okay. The new carrying value of the bond is 208,530 minus 744. Okay, and remember that when we amortize the premium, the carrying value of the bond or the issue price is going down. For the discount, the issue price is going up. When we amortize the bond discount, the issue price of the bond or the carrying value of the bond is going up. But for the premium, now this is going to be smaller, and this is going to be, the issue price is going to be, or the carrying value is going to be smaller. In this case, like what we said here, 208,530 minus 744, and that will give us 207,786 as the new carrying value of the bond. And we do like what we did earlier. We multiply. It's better to, I'm using different pens here. So we say 2, then this new carrying value, 207,786 times the market interest rate, 6%, times the time, 6/12, because it's every 6 months. And in this case, 207,786 times 6%, times 6 divided by 12, and it's going to be 6,234. 6,234. It's actually 6,233.58, but we put it to the nearest number. Be careful now. Usually there are some softwares that will give it to the penny. Okay, but we are just doing it here for simplicity. Okay. All right. So like we did with the first journal entry, we debit interest expense. Okay. Debit interest expense, and we automatically credit cash for $7,000. That is the obligated value, the obligated cash or obligated interest we pay to the bondholders. And the interest expense is $6,234. And the difference between the two is a blank figure, the unamortized bond premium. Unamortized bond premium. I apologize on the previous. I'm glad that thing is still here. It's not discount, unamortized bond premium. Over here, sorry, because we already did the discount. And so this is unamortized bond premium, okay? The first general entry, unamortized. And so the unamortized bonds premium is going to be the difference between 7,000 and minus 6,234, minus 6,234, and that's 766. So the unamortized bond premium will go down by 766, okay? Now, to do the third journal entry, we update the new carrying value. We update the new carrying value. So the previous carrying value was 207,786. Now, remember, it is going down. The original issue price going down. So 786 minus 766. That's what we amortized this time, and that is going to give us okay, 207. Now wait a minute. Yeah, that's correct. 207,786 minus 766, and that gives us 20,000 and no, 207, that's wrong. 207,786 minus the previous carrying value minus 766. Yeah, that makes sense. 207 and $20. 207, $20. Okay, now the new interest expense is going to be 207, 020 times the market interest rate, 6/12. 6%. 6% times 6/12, and that will give us 207,020 times 0.06 times 6/12, and that gives us 6,211. 6,211. Okay, 6,211. And you notice that every time it goes smaller and smaller and smaller and smaller because the carrying value is going down. So we multiply the interest rate by a smaller number every time by a smaller number. Again, we do the same like what we did here. Debit interest expense for 6,211 and credit cash for 7,000, and the difference between them is how much you amortize. Okay, so this is the amortization of bond discount and premium, and we have to do that, guys. Corporations and businesses must do that because it has a great effect on our interest expense, how much we recognize interest expense in the income statement. So if you when you collect or when you get the issue price of the bond, whether it's a discount or a premium, is going to have an effect on our interest expense. Okay, so amortization, okay, meaning that we assign, meaning we see the effect on interest expense. Okay, the effect of discount or premium on the interest expense. So when we do the payment of interest, we will see how much is the interest expense. Okay, all right, that's the end of the bond discount, amortization of bond discount or premium. By the way, if the issue price of the bond is the same as, if the market interest rate is the same as the stated interest rate, then there is no amortization here. You debit interest expense, credit cash, debit interest expense, credit cash. Okay. All right, now we are going to move into, we're going to switch gears, like I promised you, to the statement of cash flows. We're going to switch gears to the statement of cash flow, and we're going to do a comprehensive problem that will explain. I thought my cell phone is, I have it on silence. Okay. Let's see which problem we are going to do. I'm going to get the textbook. You're going to see me carrying the textbook, so please bear with me, be patient a little bit. Okay, I'm going to use, let's see, problem 8, guys, page 643. Problem 8, page 643. So you get your book to that comprehensive problem. So this comprehensive problem says Shah Fabrics Incorporated comparative balance sheet for December 31st, 2014 and 2013 as follow. Okay, they are giving it as follow. As you can see, let me put it closer to you. Maybe you can see it. Okay, and here are some additional data in the bottom. Okay, some additional data in the bottom. You see it? Okay, I just want to do the 3 sections of the statement of cash flows. Okay, they have additional data on the bottom. Additional information about Shah Fabrics operations during 2014 as follows. So the net income is 112,000. They have a building and equipment depreciation expense amount of 60,000, 12,000 respectively. They have equipment that costs 54,000 with accumulated depreciation of 50,000, sold at a gain of 21,200. And then you have equipment purchased for 50,000. You have a patent amortization for 12,000. You have purchase of a patent for 1,000. You have funds borrowed by issuing notes payable at 100,000. Notes payable repaid 60,000. Land and building purchase for 648,000 by signing a mortgage for a total cost of and then we have 6,000 shares of $40 per value common stock issued for a total of $200,000 and paid dividends $36,000. Okay, let me just again, we are going to use the indirect method. Okay, we're going to use the indirect methods. There are two methods, the direct and indirect. The indirect is the most widely used method, so we will do that. And like we mentioned in our class, guys, there are three components of the statement of cash flows. Cash flow from operating activities, cash flows from investing activities, and cash flows from financing activities. Operating activities, the two methods, the direct and indirect methods, differ in the operating activities, cash flow from operating activities. The way to figure it out is different in both methods. In the indirect methods, so we take indirect method, cash flow from operations, we take the net income and we adjust it from accrual basis to cash basis. Okay, so in this case, the net income that they gave us was 112,000. Okay, the 112,000, that means that was an income done on accrual basis, but we're going to change it to a cash basis. So we got to add and subtract items from it. Okay, so what we do, usually you look at the income statement itself. If we have depreciation, if we have amortization, if we have depletions, we originally deducted those. In this case, we have to add them back to the net income. If we have gains, we originally subtracted it. We have to add, we originally added the gains, but when we do the operating section of the cash flow from operating activity, we deduct the gains, we add the losses, okay, because we originally deducted those, so we have to add them back. And also we look at current assets and current liabilities of the balance sheet. Now remember, if you remember in our original, when we have the discussion about it, we said that increases in current assets are subtracted from net income and decreases are added. So it's an opposite correlation between net income and changes in current assets. Okay, so you subtract the increases and add the decreases. Okay, and for current liabilities, it's a mutual correlation between net income and changes in current liabilities. So we add the increases in current liabilities and we subtract the decreases in current liabilities. Okay, so let's see, based on this problem, first we're going to do the first component is the cash flow from operating activities. That's the first component. Okay, like we said, we start with Oh, I need a place to put. I'll put it over here. Please bear with me. I'll be going back and front to look at the numbers. We know that they gave us. So first, we're going to put the title. The title. Of course, that's going to be the name of the business. In this case, it's Shah Fabrics. And then we put the statement of cash flows. And then for the year ended such and such. Okay? So if you have to do a problem guide, make sure you don't just leave the title like that. You got to put the name of the business, statement of cash flows, and for the period ended or for the year ended such and such. Okay. In this case, the net income that they gave us is, I think it's 112. So we put the title cash flows from operating activities. Okay, this is problem 8. Problem 8, page 643. Okay, problem 8, page 643. Okay. Cash flow from operating activities, we start with net income. All right, in this case, it's 112. Okay, $112,000. All right, now we're going to adjust that. We're going to look if we have depreciation, amortization, depletion, and then we deducted it from that. We're going to look for gains and losses. We're going to look for changes in current assets and current liabilities. Okay, so we do have, let's see, we have depreciation on buildings. We have depreciation on equipment, we have amortizations, and we have gain on sale of equipment, okay? So, that's what the problem is telling us. All right, so we remember those, we add those back. So we're going to say add depreciation on building first. Depreciation on building, it was for $60,000. And then we have also depreciation on equipment for $12,000. Okay, and then we have amortization of a patent. Amortization of patent, okay, for $12,000. Okay, and we also have a gain on sale of equipment. Now the gain on sale of equipment we subtracted. Remember we said we subtract the gains and we add the losses. Okay, so gain on sale of equipment. Gain on sale is stated in the problem. Sale on of equipment, and the amount was $21,200. Notice I'm putting it between two brackets because we are subtracting that, and I think that's it. And then we don't have, that's all what we have, what the problem is telling. Now we're going to move to changes in current assets and current liabilities. Remember, we add the decreases in assets, we subtract the increases in assets to the 112,000, okay? For current liabilities, we add the increases we subtract the decreases, okay? So let's take a look. Look only in the account receivable. Account receivable was 301,720 in 2013, 409,720 in 2014. In this case, we have an increase. We have an increase of 108,000. Okay, so we subtract, remember, based on the rule, we subtract the increases. So we have increase in accounts receivable, okay, for 108,000. I put it between two brackets because it's a, and then next we have inventory. The inventory went down from 551,560 to 451,560. So we have a decrease of 100,000. We have a decrease of 100,000. So decrease in inventory for $100,000. So I don't put it in brackets, okay? Remember, it's an opposite correlation. You add the decreases and you subtract the increases, okay? So this is a decrease in inventory. All right, let's look, what else do we have? Prepaid expenses. That's it. That's all the current assets that we have. We have the cash, because the cash, we don't do it because this is, we're trying to explain the difference in cash. Okay. And okay, so we look at current liabilities now. Oh, we still have prepaids. Sorry, prepaid expenses was 80,000. It's all gone. Decrease in prepaid expenses. Decrease in prepaid expenses, okay, for 80,000. It was 80 in 2014, then it's all gone. Okay, so since it is a decrease, we added to the 12,000. Okay, now we go to current liabilities. Let's take a look at current liabilities. Okay, we do have accounts payable, and we have notes payable. It says it is current. So and then we have accrued liabilities. We have 3 liabilities. Okay, so we have a decrease. Okay, where was it? Here. Accounts payable went down from 147 to 43. Okay, that means that's a decrease of 104,000. So decrease in accounts payable. Decrease in accounts payable. Okay, for 104,000. I'm putting it between two brackets. Remember, with liabilities, we add the increases and we subtract the decreases. So in this case, it was decrease in accounts payable. Okay, and then we have notes payable. Okay, well, it looks like notes, where was that? Notes payable in 2013. 49. Okay, I think the explanation is telling us that let me go back to that for a second. Funds borrowed, sold it again of such and such, building, Okay. Well, I think 49. Okay, accrued liabilities. So the accrued liabilities that we had was 49,200. It's all gone. Accrued liabilities 49,200. Okay, 49,200 accrued liabilities. Accrued liabilities. Okay, for 49,200. 49,200. Okay, that was a decrease in it. Okay, so that's why we put it between two brackets as a deduction. Let's say, do we have any more? No, that's all current assets and current liabilities. Now we're going to do our additions and subtractions. We're going to do our additions and subtractions. So let's take a look over here. Okay. We're going to go to the calculator. We started with 112,000 plus 60,000. Okay, plus 12,000 plus another 12,000 minus 21,208. Okay, minus 21,200. Sorry, 21,200. That's one. 21,200 minus 108,000. Okay, plus 100,000. Okay, plus 80,000. Okay, minus 104,000 minus 49,200. And that will give us 93,600. Okay, so that is the net cash flow from operating activities. Net cash flows from operating activities. Okay, and it is 93,600. That's the first component of the statement of cash flow, net cash flow from operating activities. We started with that, like we said, we are using the indirect method. We adjust the net income. We took net income, we added and subtracted from it. We look at our current assets. We increase the decreases. We decrease the increases. For current liability, we increase the increases and decrease the decreases. Okay? So it's a mutual correlation with current liabilities and opposite correlation with changes in current assets. Yeah. So let me say, I think I'm confused. Let me pay attention to what I'm saying. We add, it's an opposite correlation with current assets. We add the decreases, subtract the increases. Mutual correlation with current liabilities. We add the increases and subtract the decreases. Okay? All right. So the first component is cash flow from operating activities. Next is cash flows from investing activities. So this is the first component. Cash flows from operating activities, and it was 93,600. Okay. Now we're going to do cash flows from investing activities. Cash flows from investing activities. Okay? Cash flows from investing activities. Okay? Investing. And that has to do with sale and purchase of long-term assets. If we have a sale of long-term assets, that means we have cash inflows. If we buy long-term assets, then we have cash outflows. So let's take a look in the problem. Okay. It looks like we have a purchase of equipment. I'm looking at the extra data that was given to us. Okay, we have equipment that costs 54 with accumulated depreciation of 50,000. That's sold for 21. Equipment purchase. So we have equipment purchase for 50,000. Okay, 50,000, and then we have a sale of equipment. 21. Sorry, what was it then? Equipment cost 54,000 with accumulated depreciation of 50,000. So 54,000 minus 50,000, that will give us 4,000 as book value. As book value, we sold it for 21,200. Okay, sold it for 21,200. So that will give us a 54,000 with accumulated depreciation of 50,000. Okay, 4,000, and then you add that to the gain. So the total inflows was 25,200. 25,200. 21 plus the book value will give us a 25,200. So we have purchase of equipment, purchase of equipment, that is a long-term assets for 50,000. Remember, it's a purchase, negative 50,000. And then we have sale of equipment, 25,200, sorry, 21,500. And that's, like we said, it was, the problem is telling us, it was the cost 54,000 minus accumulated depreciation 50, that's 4,000. Plus the gain 21,200, so that's 25,200. So the gain 21,200 plus the 4,000 book value. Altogether came up to 25,200. Sorry, 25,200. Okay, 25,200. Okay, what else do we have? We purchased let me see what else. Oh, we purchased of a patent, 4,000. Purchase of a patent, 4,000. Purchase of patent for 2,000. That's a negative. Purchase of a patent, 4,000. Sorry. What's happening to me here? 4,000 is a negative. Okay? 4,000 is a negative. Remember, this is a increase in assets. Remember, we said we deduct the increases, subtract the increases. Deduct the increases. Boy, let me say it one more time. Deduct the increases and add the decreases. Okay, deduct is an opposite correlation with assets. Add the decreases, subtract the increases. Okay. In this case, we have a purchase of patent. That means our assets increase. Therefore, we deduct that. Do we have any more? Let me take a look. Purchase of a patent. Okay, we have bonds borrowed. That's a liability. Shares, notes payable. Okay, that's financing. Land and building purchased by signing a mortgage. Total. Okay, there's no cash involved here. 6,000 shares. That's a financing activities. Okay, no more investing activities. So cash flows from investing activities is equal to, okay, we have a $50,000 negative. Negative $50,000, and then we have plus 25,200 plus, or sorry, that's a negative 4,000, negative 4,000. So that would give us a negative number of 28,800. So cash flows from investing activities is negative 28,800. Negative 28,800. Okay, so this is the second component. Okay, in the operating cash flows, we have positive 93,600. On the cash flow from investing activities, 28,800. Now we're going to go to the cash flows from financing activities, the third one. And we don't have a space on the board. So please, as of make sure you have your numbers. I'm going to wipe out, clean some stuff so I can make space for, usually it's supposed to be in the bottom in here. Okay, but since there is no space, let me see if you can. Let me see, maybe I can do some space. Let's see, financing activities, guys, have to do with long-term liabilities and stockholders' equity. Financing activities. So we look at the transactions that has to do with long-term liabilities and with stockholders' equity. So let's see what the assumptions are telling us. Okay, we have equipment purchase $50,000, patent amortization 12, purchase of a patent, funds borrowed by notes. Okay, we have a note. We borrowed funds, note payable, and then it was they paid 60,000 of it. And then we have land and building purchased for 640 by signing a mortgage for those. Okay, signing a mortgage. So we don't have any, we just signed it right now. There's nothing happening at the moment. And then we have 6,000 shares for $4 and 6,000 shares for $40 par value stock for a total of $200,000 and paid cash dividends of $36,000. So it looked like we have the notes payable, and I'm looking in the textbook on the problem 8, because I can't carry the book with me, so I'm putting it here. Okay, so we have the note payable for $100,000, and then we have the payment of $60,000, and we have the stocks for the 6,000 shares They are sold for $200,000. That's and then the payment of dividends for $36,000. That's the total financing activities. Okay, so if I want to do, I'm going to try to see if I can do a small writing here. Okay, cash flows from financing activities. Cash flows from financing activities. So we have cash flows from investing, cash flows from operating activities, that one, and now we have cash flows from financing activities. Okay, so we have the notes, issue of notes payable for $100,000. Okay, we have payment of notes, $60,000. Payment of note, $60,000 negative, because that's, remember, we add the increases, we subtract the decreases. Okay, so that's a payment of the note, and then we have issue of common stock for $200,000. That is a positive, okay, because we're collecting cash. And then we have the payment of dividends. Payment of dividends for $36,000, that's negative. Okay, now remember we said for the dividends, guys, if we are receiving the dividends, okay, that goes on the operating section. If we're paying it, that goes into financing section. So in this case, 100,000 minus 6,000 plus 200,000 minus 36,000, that give us a positive 204,000. Cash 204,000. Cash flow from financing activities. Cash flows from financing activities is 204. Now, if you add the three subtotals, okay, add the three subtotals, what do we get? Okay, where's my calculator? Here it is. Add the three subtotals. 93,600 minus, okay, minus 2, well, I can't even read my handwriting, minus 28,800, okay, plus 204,000. And that give us 268,800. The three of these subcomponents, okay, 268,800. 268,800. That is the overall results of the statement of cash flows. Now, let's check if our answer is right. If our answer is correct by looking at cash. By looking at the cash at the beginning of the year, take a look in the problem. Look at the cash. In 2013, it was 109,400. 109,400. In 2014, it grew to 378,240. What's the difference between these two? If we come up to 268,800, that means we're good. So let's see. Okay, let's see. Okay, 378,240. That's the ending balance of cash for 2014. 378,240. 378,240 minus the beginning, which is in 2013, 109,440. 109,440. 268,800. Well, good. That means that's your check figure, is the cash. Okay, that's it. That's a comprehensive problem of statement of cash flows that covers the chapter in general, okay? Well, I want to say if you have any questions, but we are not in the class, okay? So today, as I promised you, we covered the amortization of bond premium and bond discount. Like we said, there are two methods of amortization: bond premium or discount, the straight line method and the effective interest method. And the amortization is very important because it has a direct effect on the interest expense that we recognize. When we have a discount, it tends to increase our interest expense. When we have a premium, it has a tendency to decrease a little bit our interest expense, okay? So that's why we have to amortize those. And then also I promise you to do the statement of cash flows. So this is a comprehensive problem, problem 8. Okay, problem 8, page 643. I'm looking in the book. Page 643. Please get your book and practice. But you have to do the chapter assignments that are posted on JAX. But if you want the total understanding, you got to see how we did this comprehensive problem. Follow the directions that I talked about. You will find it, but when you read the textbook and compare with what I'm saying, that will really enforce your knowledge for the both topics that we talked about today. Okay, I'm going to stop the recording, and everyone have a good day and stream and